Hello folks, you're welcome back. This is Charis Trading Institute. In today's episode, I'll be sharing with you from the ICT price action lesson of the ICT month 1. This is the summary of month 1 of the ICT mentorship, okay? And the topic we'll be considering today is the elements of a trade setup. If you stay till the end of this video, you are going to learn what it means and you're going to have a detailed perspective of the ICT mentorship, especially the month 1, because this is what I'll be focusing on. And in subsequent videos, I'll be taking you through the journey to learn ICT, okay, properly, the journey to learn ICT concept more refined and more explanatory. If you're a new viewer on this channel, I would like you to click the subscription button and don't forget turn on your notification bell so you stay updated every time I post a video on this channel. You can as well go through my channel and see lots of video lessons for beginner forex traders and intermediate forex traders. There are a lot of lessons on this channel you can adopt and strategies you can use to make so much money from the forex market. Okay, so let's consider today's lesson. So there are 4 elements of a trade setup, also called the interbank price delivery algorithm by ICT. Okay, these 4 elements of a trade setup are the things you are going to constantly see repeatedly on the chart, irrespective of the asset class. Every chart has these things that I'm about to teach you. Okay, there are 4 elements of a trade setup, and as you can see them, the first is you have a consolidation, you have expansion, you have retracement, and reversal. This is how price is delivered on any asset. Okay, price is either in a consolidation or price moves away from a consolidation and creates an expansion near term. Okay, or price is either retracing into a fair valuation or reversing from one point to the other. These are the 4 things that make up price, irrespective of the asset class that you are trading. Okay, so we are going to look at expansion. What is expansion? Expansion is when price moves quickly from a level of equilibrium. Price moves away from a level of equilibrium or a level of consolidation to create an impulse swing or a new price leg. This is what is called expansion. Okay, why is it important? It is important because when price leaves a level quickly, it indicates the willingness on the part of the market makers to reveal their intended repricing models. So how we know the intention of the market makers towards their new repricing model is to look at the expansion or the new price leg they have created. Okay, it's called an expansion, or sometimes called even an impulse swing. So when price expands, what should we pay attention to? When price expands, we should pay attention to the order block that price expanded away from. We should pay attention to the order block, okay, that price expanded away from. So let's look at a typical example of what this is on a chart. Okay, so this is a chart showing a typical example of price expansion away from a level of consolidation or a level of equilibrium. Price was previously in a level of equilibrium as depicted in this blue shaded box, price having relative equal highs and relative equal lows. And we saw the market makers created their new repricing model by expanding to the upside. Okay, this is to reveal to us their new repricing model, which is bullish. So what should we pay attention? We should pay attention to the order block that price expanded away from. This is that order block that price expanded away from. Price would usually return to the order block, okay, for smart money to re-enter their trades or to position their trades. So this is where smart money position their longs. This is what it typically means. So this is also another chart showing a region of consolidation before the market makers expanded to the downside, and we said that when such happens, we should pay attention to the order block that the institutions or the market makers expanded away from. Okay, you can see this is that order block. The institutions will usually return to that order block to re-enter their positions. Okay, in this case they enter their shorts at the order block. Okay, so this is how expansion is useful. So this is how expansion is used in your trade. This is also another region of consolidation. Okay, price expanded away from and price returned into the order block that the price expanded away from. This is where institutions will usually enter their short positions. Okay, so this is what expansion is. The next is retracement. What is retracement? Retracement is when price moves back inside the recently created price range. Okay, when price expands, we don't just get to enter a trade in the expansion. We wait for price to retrace into the recently created price range. Okay, you must have heard me called it internal range. That's what it is. Price would usually retrace into that internal range, and when price returns inside the recent price range, it indicates the willingness on the part of the market makers to reprice to levels not efficiently traded for fair value. So what do we pay attention to when price creates an expansion and is about to retrace? We pay attention to liquidity voids and fair value gaps. The purpose of retracement is for fair valuation. It's for fair valuation. For example, the market makers are willing to buy Bitcoin at levels worth $60,000, but you are not willing to sell at $60,000. You will be willing to sell at $70,000, but the market makers are probably not willing to buy at 70, but they will negotiate for $55,000. So it's for $65,000, I meant to say. So it's not 60 and it's not 70, it is $65,000. That kind of repricing is called fair valuation. That's what it literally, I'm just giving you a literal example. Okay, so this is a typical chart showing price expansion and retracement to refill what? Liquidity void. This is a liquidity void. Okay, this one-sided price delivery is a liquidity void. Price returns to rebalance that void. This is what you target during a retracement move. You look out for what? Liquidity voids or fair value gaps. This is also another expansion. Price created an expansion leg and retraced into what? Fair value. Fair value. So we are paying attention to fair value gaps when price is retracing. This is also another price range. Price created an external range or expansion. Price retraced into what? Fair value. So you see that, right? This is how to use retracements, or this is how to look for retracements when you are trading. Then the next is reversal. Reversal is when price moves the opposite direction of the current market trend, or the current direction that the market has taken. When price takes the opposite direction, for example, if we are bullish and price begins to imprint bearish signatures, we can say that price is reversing from a bullish market trend and is beginning a bearish market trend. Okay, what is the importance, or why is this important? It's important because when price reverses direction, it indicates that the market makers have run a level of buy stops or sell stops. Okay, and a significant move should unfold in the new direction. So in summary, what this is saying is that when liquidity is taken either above the marketplace in form of buy stops, or when liquidity is taken below the marketplace in form of sell stops, we should begin to see the market unfold a new level of liquidity to the opposite direction. Okay, when price is bullish previously and it takes out buy side liquidity, we should see price showing signatures to start going the opposite direction. This is what reversal is. So what do we look for in price? We look out for liquidity pools just above an old high or relative equal high, or just below an old low or relative equal lows. This is what to look out for. Reversal. So you can see this is a level of relative equal high. Price ran liquidity residing above it. What happened? Price reversed. At the same time, price created a new low, and this is sell side liquidity residing below it. Price ran below it to take out the sell side liquidity or sell stops, price reversed. The same thing here, price run buy side liquidity, you see reversal, price run sell side liquidity, you see reversal. Okay, these are the elements of a trade setup. The next is consolidation, and consolidation is when price moves inside a clear trading range and shows no willingness to show significant higher or lower moves. Price is between a range. Why is this important? When price consolidates, it indicates that the market makers are allowing orders to accumulate on both sides of the market. So you expect a new expansion near term. When you are in a level of consolidation, you should anticipate to see a new expansion either to the upside or downside in the nearest term. What do we look for in price in a level of consolidation? We look to see an impulse swing away from that level of equilibrium, okay, that is found exactly halfway point of the consolidation range. This is what it means. This is a level of consolidation, okay, price forming relative equal highs, relative equal lows. When you put your Fibonacci between the low to the high, 50% is that equilibrium. We would like to see price expands away from 50% of this range. So price expanded from 50% of this range of consolidation and started to go up. So guys, this is what consolidation is. If you enjoyed this lesson, I'd like you to click the subscription button. Don't forget to like this video, share this channel, and until next time, I wish you good luck, good trading.